Hi everyone, and welcome back to the channel. While most of the buzz these days has to do with the tax-free savings account, we thought it would be a mistake to forget about all of the benefits RSPs can still offer us. So today, we're switching gears to focus on the original powerhouse of savings, the RRSP, and show you why an RSP can still make sense for you, even at low levels of income or early in the start of your career. Now, when most people hear RSP, two things generally come to mind: saving for retirement and the tax refund you get by making contributions. So let's take a closer look at why those usually matter most to us, but why we might be thinking about them all wrong. The primary goal of an RSP is to encourage you to save for retirement. The purpose of the account is to have us save money throughout our career, creating your own personal nest egg or self-funded pension plan, if you will. When you contribute to an RSP, in your mind you're thinking that money is locked away in a box and it doesn't open again until I turn 65. However, there are rules in place that allow you to access your RSP sooner, and we can use that to our advantage sometimes, especially if we're retiring earlier than we expected, which we'll talk about a little later in this video. Next up is the tax refund you get by making RSP deposits. Putting the money into an RSP means you don't need to pay tax on that portion of your income. Instead, you pay the tax when you take the money out. As an example, let's say you made $54,000 this year and you decide to deposit $5,000 into your RSP. Your taxable income now in the eyes of CRA is only $49,000, meaning CRA is only going to charge you income tax on $49,000 out of the $54,000 that you made. If you already paid tax on the full $54,000, which you likely did over the year when you had tax deducted from each of your paychecks, CRA will refund your taxes to you that you paid on that $5,000 when you file your tax return. For 2021, any income that you make over $49,000 is taxed at 20.5%. All of the income below that, though, is taxed much less at 15%. This means that RSP deposit saved you from paying taxes at that higher tax rate. Now, this is a simplified example since there's also provincial taxes that we have to pay as well, but the logic works the same. In retirement, our income will likely be lower, so you can withdraw that $5,000 later on in life and pay the lower tax rate. You're taking control of when and how much tax you're going to pay by deferring it through your RSP. If you're interested in seeing more examples of how income tax works and other RSP strategies, we'll include links to some helpful videos in the description below. So what happens if you plan on retiring before 65? Does investing in RSP still make sense? And if so, when do you start cashing them out? Canada has a number of programs in place to help us with our daily bills once we hit retirement. The most famous is the Canada Pension Plan, or CPP. CPP can actually be as much as $1,200 a month once you retire. The average Canadian, though, receives much less than that, closer to about $700 a month. And that's far less than what we need to survive. The amount of CPP that you'll get is based on how much you paid into it while you were working. Each paycheck, a little is taken off automatically and added into your Canada Pension Plan. To help bridge that financial gap in retirement, there are other programs in place like Old Age Security and the Guaranteed Income Supplement. There are a few catches to these programs, though. CPP is meant for retirees at age 65 or later. You can ask to take it as early as age 60, but when you do that, the amount that you're going to get each month is now reduced. OAS and GIS are only available at age 65 and older, and they're only eligible at certain income levels. The more you make, the less you're entitled to until eventually you aren't eligible to receive any of the benefits at all. So what do you do then if you're retired at age 45 or 50, for example? Should you use up your non-RSP savings first, like the tax-free savings account, and then wait until 65 to access your RSP? Or should you maybe consider tapping into your RSP much earlier to fund the years between age 50 and 65 before things like CPP and OAS kick in? Some of you might be wondering, can you even withdraw from your RSP before age 65? Yes, you can access your RSP before 65 if you need to. If you've retired early and you're not receiving any income, regardless of age, it makes sense to consider withdrawing your basic personal amount from your RSP. Now, the basic personal amount is the amount of income that you can earn each year tax-free. Compare this to our earlier scenario where your marginal tax rate was closer to 20%. Now, you can withdraw more, but you will pay taxes on income above that amount. So, ideally, you're only withdrawing the amount that you need. By using your RSP to fund the early years of your retirement, you can then strategically use other savings to supplement your CPP and OAS later on. Cashing out your TFSA, for example, once you start getting CPP and OAS, won't count as income for tax purposes. This can make a big difference in the amount you receive from OAS and GIS, and also on your final tax bill at the end of the year. Remember, the higher your income in retirement, the less OAS and GIS you're entitled to receive. You're also avoiding lower monthly CPP payments by waiting until 65 to take your payments. Hopefully, we've been able to show you that despite other accounts receiving most of the attention right now, the RSP can still have a place in everyone's portfolio. Thanks so much for watching, and we'll see you next time.